All right. What's going on, everybody? I think we are live. Let me know in the chat whether you can see and hear me okay. Good to see all your smiling faces today. Interesting week in the markets. We've got the S&P 500. Looks like it's going to be closing at an all-time high. Nasdaq not quite there. We're close, but at the end of October, the Nasdaq was higher. Dow looks like it's probably going to close at an all-time high, at least an all-time high closing price. Russell 2000 almost certainly will be closing at an all-time high. Dollar is still headed higher, and we got yields on treasuries started off higher, at least long-term treasuries start off higher, and then have been moving lower throughout the day. Bitcoin's still kind of moving sideways. It's been moving sideways really ever since November. Gold ticking up a little bit higher. Silver up another 4% today. It's at about $80 right now per ounce. So interesting week in the markets. Looks like most of you, your portfolios are probably doing pretty well today. So throw any questions that you have for me in the chat. Make sure you tag me so that I can see the question. Otherwise, I might miss it. And as always, I will definitely 100% answer every single super chat. What do you think about getting into USO right now? I do have. I don't know if I have a position. I think I still have a position in USO. Let me check. Overall, right now, I'm fairly bullish on oil. Okay, no, I don't have a position on USO right now. Energy overall, even oil, especially oil companies. Like I've got a good long position on Exxon, so I am pretty bullish overall and on energy. So USO specifically, it has been moving sideways for quite a while now. In fact, is at the exact same price it was in January of 2016. So if you had bought shares of USO in literally exactly 10 years ago, January 9th, 2016, what was the price per share January 9th of 2016? On the 9th of January, okay, well that was a Sunday. So the 11th of January, you would have bought it at 74, somewhere around $75 a share. And today it is trading at $71 per share. So you'd be at a slight loss right now. So it's been volatile, but it's been generally stuck in between the range of like 70 to 93 that whole time. Had a brief period back in 2020 when it dipped below, brief period in 2018 when it rose above, but it's been stuck in that range for quite a while. When we do get a breakout, we should have a pretty violent move, but who knows how long that'll take. Hey, Joe, it's Rob in Seattle. I made a live market end. Well, thanks for joining. Good to hear from you, and have a drink for me. All right, let's see here. What's your take on the fundamentals of AI foundation companies like OpenAI, Oracle, or CoreWeave? I can't make the valuations make sense to me. Yeah, I mean, okay, on one hand, it's like if you can't make the valuations make sense to you and you've done the work, let's say, you're not just kind of casually glancing. You've done the work and you cannot make it make sense. It's like Warren Buffett, don't invest in something you don't understand. Um, on the other hand, you always have to ask the question, what what do other people and what does the consensus believe about this I'm like, what how could I be wrong? You have to approach it with a truly a scientific approach, trying to prove yourself wrong. And really the answer comes down to the market believes that the future growth justifies paying the price right now. Because at the end of the day, that's all we're trying to do when we're looking at valuations. Companies are money printers. So, like, you have a printer at home, you send something to the printer, prints out a little piece of paper for you. If it printed out money, then maybe you could sell that printer. Let's say it was a legal money printer and it wasn't going to be, against the law. There's no counterfeiting there. You could print out dollar bills. Well, if you were going to sell it, let's say it could print out $100 every year. If you're going to try and sell that printer, people would be asking you, well, does it always print out exactly $100 per year? Maybe like last year it printed out $90. This year it printed out $100. Next year, we expected to print out $110. That changes how much somebody's going to pay for that printer from you. Let's say the printer itself is like very unreliable. Some years it prints out no money. Some years it prints out a couple $100. Sometimes it won't plug in, won't turn on. Like it's very unreliable. That's going to change how much you can sell it for. And so let's say it prints out no money, but it's like loading. It's got like a little loading bar, and it's like, okay, well, in 10 years, it's going to print out, $1 million. Then it's like, again, that changes how much people are going to be willing to pay you for that printer. And that's all we're trying to do here when you're valuing companies. You're trying to see, okay, what is the most likely outcome in terms of how much money this will print out for me. And then you weigh that against all of the other options about how much money the other printers will print out for you and the likelihood of that actually happening. And then you decide where you want to land your money based on that risk and reward ratio. And so it's just the potential for that future growth that the market is pricing in that maybe you think the market is wrong about. But at the end of the day, in order to make money investing, you do have to bet against the consensus, but you also have to be right. When you're buying something, you think that the market is undervaluing it. When you're not buying something, you think the market is overvaluing it, at least relative to its to the alternatives. So specifically about companies like OpenAI or Oracle or CoreWeave, it's like you can get into that space in companies that have a lot better valuations. All right. Next question from Peter. Thoughts on LAC? Lithium Americas Corporation. So we had a big gap up last year back in September. And then it popped from about $3 a share all the way up to about almost $11 a share. And it's retraced down. It's trading above $5 a share now. Looks like we are holding pretty strongly above that support at about 435. We bounced off of that a couple of times since November. It looks like it's kind of struggling to get above resistance here at like 560. There's some long-term resistance there. So technically speaking, we're in a tight range that it looks like it might have trouble getting out of, both to the upside and to the downside. Obviously, fundamentals will trump that. If there's something that fundamentally that happens that is very bullish for this company, it'll pop right away. I don't know anything about the fundamentals of this company. Market cap, it's fairly small. It doesn't look like it's making any money. It's not profitable. Negative earnings. Where is this one? Is this one located in the Thacker Pass project? Located in northern Nevada, headquartered in Canada. So we don't have like jurisdiction risk with that company, so that's probably a positive. but I'd want to know why they're not making money. I don't know too much about the company itself. Okay, from GNGR, should I keep cash heavy on the sidelines? Personally, I like having about 5% in cash and cash equivalents. So that's checking account, savings account, high yield savings account, money market funds, T-bills. The reason why is because when when you talk about keeping cash on the sidelines, the purpose of that is so that you don't have to become a forced seller when assets go on sale. And um, so that is the main point of reserves. A, so you're not a forced seller of assets. B, so that you can buy assets when they're on sale relative to your cash position. Warren Buffett right now has about 30% in cash. And so a lot of times when individuals, like retail individual traders, talk about, hey, I'm like heavy in cash, I've got cash on the sidelines, I'm waiting for a crash like Warren Buffett. It's like, well, you have a lot more in cash than even Warren Buffett does. He's got only 30%, and you're talking about 50, 60, 70% in cash. Um, and so that is extreme bearish positioning relative to, even like Warren Buffett. So that's one thing. Even he only has like 30%. The second thing is the allocation I normally talk about is 30% reserves, even though only 5% of that is US dollars. About 20% is gold, about 5% is Bitcoin, and 5% is cash. And so that is a typical allocation that I talk about and I try and stick to, because then you get the reserves portion without having to get your purchasing power eroded from inflation. So if you look at that allocation, even just, I mean, over the last 100 years, it's just destroyed the major indexes, destroyed 60/40. But even over the last like 20 years, there was a period of time when stocks were insanely outperforming gold. So you look at like 2011, 2012, 2013, 2014, 2015, like during that whole time, you're slowly rebalancing by reallocating some of your stock positioning into your gold positioning, because you're becoming every year more and more overweighted in stocks, underweighted in gold, and so you're just rebalancing between the two. And relative to each other, you are buying more gold and selling stocks. Um, but then that flipped within the last couple of years. Gold has insanely outperformed stocks. And so you'd be doing the same thing right now. Over the last couple of years, you'd be slowly rebalancing by selling some of your gold and buying stocks. Now, rebalancing, that means you're buying and selling relative to the outperformance and underperformance of your different allocations. Both gold and stocks have been going up. It's just gold has gone up a lot more. And so uh, doing that in your portfolio allows you, in my opinion, the kind of the best of both worlds. You don't have to choose to just be out of the market. You have a positioning that protects you against inflation, and then also allows you to take advantage of sales, and it allows you to actually see the true sales like when they're happening. Um, Stocks might not go down relative to dollars, but they've gone down relative to gold. Um, and so I do like having some in cash, but not a whole lot, because you run the risk of getting burned from inflation. All right, question from Christopher. Good afternoon. If you're familiar with ONDS, please comment on getting involved after today's $1 billion offering. I am not familiar. ONDS. Let's see if I can offer any educated insight at all. ONDAS Holdings. This looks like a very volatile stock. Market cap 5 billion. Electronic technology. Okay, this company is in the development, marketing, and sale of wireless radio systems for secure, wide area, mission critical business to business networks. It operates through the Ondas network, Ondas automated system segments. Okay, yeah, I don't. Commercial drone. Yeah, I'm not. I don't have any insight that would offer any educated opinion whatsoever on this. Um, Chart wise, it looks good. Excuse me. Not amazing. Looks like we just hit long-term resistance there at the old all-time high and fell pretty strongly off of that. So it may, just technically speaking, it may be a while, maybe difficult for it to break above that $15 price point. Um, Especially with the big, huge bull run that we've had since May of last year. That usually takes a lot of energy, a lot of buying power to push stocks up that much, and can exhaust buyers pretty strongly. So um, good looks chart looks good, not great. That's that's the extent of my initial thoughts on that stock. Okay, let's see here. From Whiskey Papa, if oil supply is up, wouldn't that make oil company revenues down? Or are you saying since oil companies' price will be lower now, would it be a good time to look at investing? Okay, so this is one of those weird things, and this is a little bit of a long-term explanation. This is not something that happens really in the short term, but the the idea that an abundance of supply um, will continually have the effect of pushing down prices, um, it ignores the fact that there's certain thresholds where price comes down to will actually drastically increase demand. So if you think about cell phones, the original cell phones, I don't remember how much they were. I think they were like a couple $1,000s, which in today's money is like, I don't know, 10, 15, maybe $20,000. And so they were really only purchased by the extreme wealthy, or just like the, companies who are trying to experiment with them. Like they were not a broad market product whatsoever. And then as the technology advanced to the point where the price continued to drop and drop and drop, it wasn't just those people that were buying them anymore. It soon became everybody was buying them. And so the increase in supply actually increased the available demand for it as well. And so you didn't get the same drop in price that you would have expected from the massive abundance of supply, where you'd have expected, okay, well, if there's 8 billion cell phones being made every 2 years, well, then, the price is going to be zero. Well, no, because then that once the price gets down to, $500 or so, it means basically everybody in the world affords a cell phone. And obviously there's cheaper cell phones in other parts of the world, but you get the point, is that when you have an increase in supply, you'd expect, if demand is constant, that pushes the price basically to zero, but demand never stays constant. At certain thresholds, it drastically increases demand. And in fact, the exact same thing happens with energy to a much broader scale. When you look at a lot of emerging markets, like the number one problem, economic development and health and longevity and quality of life, and it's just access to affordable energy. And you don't need that much of a drop in energy prices for it to become affordable to everybody who currently cannot afford it. And so um, the ability to profitably produce oil at a little bit of a lower price can increase demand so much that you increase your overall profits, even if your the selling price goes down. So that's a long-term thing that doesn't necessarily happen in the short term. There's infrastructure and there's laws and there's geopolitical relationships and all that come into play. Um, but essentially, the long-term game for a lot of these oil companies, if they can sustain a little bit lower prices and stay profitable, they can increase demand for their product significantly. So it's like, yeah, I'm making $1 now instead of $2 before every time I sell one unit, but now I can sell 100 times the number of units. And before I could only sell, 10 units. Okay, next question. Ooh, these are coming in quick. Sorry if I missed some, guys. Doesn't the Federal Reserve incentivize good Christ-like stewardship of wealth? No. Plus, it massively helps or even presents depressions and helps for emergencies or war. Doesn't the Federal Reserve incentivize good stewardship of wealth? No. So the Federal Reserve, the main result of what the Federal Reserve actions is that it supports the continual increase of the money supply. That means the money continually gets less and less and less valuable over time. That means that people are forced to make decisions with their money that they wouldn't make otherwise. For instance, if your money never lost value and just the value stayed the same over time, you would not be forced into trying to find assets just to preserve your purchasing power. You would save them and be able to be a better steward of your money and your wealth by identifying better opportunities. You'd be able to be more patient, and you'd be able to look at the more of the long-term time horizon on your wealth instead of being forced into a more expedient decision-making process. This is the time value of money. This is your time preference, whether society is forced into a short time preference or long time preference, and it makes decision making, financial decisions, lean more towards what is best short term at the expense of what is best long term. Now we can't help it. Like we can't cause them to do anything else. So we're just making the best decisions with what is given to us. So at the end of the day, being a good steward, that's what it really comes down to is, hey, here's the situation that you are dealt. Here are the cards that are in your hand. Being a good steward just means doing the best with what you have because we can't control what they do to the money. Um, but it would allow society wise, like on a large scale, um, it would allow better results from that stewardship because it would be a better hand. Okay, from KJ Quarter. Trying to understand Scott Besson's comments in the All In podcast stated that 2026 will be a year where it's Main Street's turn and in would be due to bank deregulation. So the rhetoric about Wall Street versus Main Street, I mean, it's all political rhetoric. You can say propaganda. That's like when the market was crashing in March and April of last year, Scott Bessent and Trump and everybody, they were coming out and saying, hey, this is for Main Street. We're getting back at Wall Street. This is for Main Street. We're crashing the markets for you. Um, and the bottom 50% of Americans barely own, or most of them don't own any stocks at all. So that's just completely not. It's not like because the S&P 500 dropped 20% that somebody that's working 3 minimum wage part-time jobs is able to go buy some stocks. That's just not. It's just not reality. Um, it is true that Wall Street was mainly selling during that time and retail was mainly buying, but it's still the upper end of the curve. I wouldn't necessarily call that Main Street versus Wall Street. Um, and so when he's talking about, hey, this is going to be Main Street's year, all he's saying is, hey, we're going to try and deregulate the banks. That's going to allow them to buy more US treasuries. When they buy more US treasuries, that pushes yields down. That means that allegedly debt should get cheaper for people. That should allow people to refinance. And ultimately, the real goal of why they're doing that is to allow the US government to refinance and to borrow at lower interest rates. But what that really does in reality is that makes it easier for them to um, borrow money into existence. That is an increase in the money supply. And that will push prices up because the government's spending more money into existence. And when that pushes prices up, that actually will make debt more expensive. It'll push interest rates for private debt higher. And so it will not have the long-term effect that they think it will. Now, there might be a short-term window of time where you have the ability to refinance because for a little bit of time, interest rates on the type of debt you have do go lower. If that's the case, take advantage of it. Don't let that opportunity pass, specifically because I don't think it will last that long. I think the market will realize, hey, this artificially low interest rate environment is going to allow the US government the government is what they're going to do with it is print more. And then that'll push private interest rates higher. By the way, guys, over the last 5 years, my average annual return, my own portfolio has been 37%. That doesn't seem crazy, but considering that the indexes over that same time, like the annualized performance of the S&P 500 was 14%, the Nasdaq was 13.9%, the Dow was 12%. That compounds over a lot over time. Over the last 5 years, the total cumulative performance of my portfolio has been about 372% versus the major indexes are all under 100% over that time, cumulative. And that's because of a trading strategy that I use with a portion of my account. And I'm having a event next Thursday, next week at 7 p.m. Eastern time. It's January 15th, next Thursday, 7 p.m. And it's free. I'm going to be teaching my strategy. It's called the Portfolio Accelerator Masterclass, a strategy with a portion of your account that contributes to boosting overall returns. And so if you are interested in joining that, it is completely free. Just click on that link in the description below. All right, next question. Do you feel like if the NFP keeps reporting low, inflation narrative will slow down? Or is the amount of credit growth will keep the equity market chugging along? Um, well, those two things are completely at least mostly disconnected. The amount of credit growth and earnings growth is going to keep the equity markets chugging along, I believe, until we get a blow off top, until we see like widespread euphoria. We'll probably continue to have volatility. Like the last 5 years, we've had 3 bear markets. It's 20% or more drawdowns. That is unprecedented. There's, I think, only one other time in history, US history, where that has happened. And so we'll probably continue to see volatility, but that's not going to contribute to what I would say would be like a long-term, like depression era, lost decade until we get a euphoric blow off top, and that has definitely not happened yet. Inflation narrative politically will continue to say, hey, there's no inflation. I think within the next 2 years, we're going to see inflation start heading much higher. Okay, let's see here. Next question from Stephen K. I've saved 60K, purchased your hypergrowth hedge portfolio blueprint 2 weeks ago. Do you have guidance on strategically deploying capital into your pies? Unsure on entry because of the recent news. If it was me, so this I don't know your financial situation other than the 60K you have saved up right now. I don't know your income. I don't know your risk. I don't know your obligations, your debt, your liabilities, anything like that. So I'm just going to like put myself into your shoes as much as I can. If this was me and I had 60K and I was like, hey, I want to start investing. Personally, I'd probably just dollar cost average in over a specific period of time. So I'd say, okay, over the next, whether it's 3 months, 6 months, or if you want to be really conservative, the next year, I'm just going to divide that out and say, okay, let's say 6 months, I want to be fully invested. I'm going to take 10 grand every single month and I'm going to invest it according to the allocation that I'm choosing. And so, if there's 3 grand of that that's going into stocks, every month on the first of the month, I'm just going to do a lump sum purchase. And I would do that if I was concerned that maybe the market was about to, fall off a cliff. Statistically speaking, the market goes up more often than it goes down. That means statistically speaking, I think it's 79% of the time, you will make more money by lump sum investing everything when you have the cash instead of dollar cost averaging. Now, if you don't have any cash and you're just taking it from your income, then what that means is you invest the money as soon as you have it. So whenever you get paid. But there is about 20% or so of the time when it works out better for you by dollar cost averaging because you're starting to invest right before the market heads down. The difference in performance between those two, like if you lump sum invest right before a market decline versus dollar cost averaging during a market decline, the difference in performance between those two is fairly small actually over the long term. So to me, the risk of missing out on, the chances of investing right before a bull market are small, and the risk of missing out on those longer term gains by not lump sum investing in the beginning, I think that's a risk worth taking if it was me. But if you are concerned about valuations, if you are concerned about war, if you are concerned about all these risks, although markets do climb a wall of worry. If you think that that is going to materialize in lower prices, then choose a set number of months and dollar cost average in. Are you bullish on real estate? What's your opinion on interest rates? I am bullish on real estate simply because of it. It's a demographics issue. Um, Over the last 20 years, we've had population growing at a pace that is more rapid than the increase in housing units. Not only that, but as time goes on, and this is a trend that's been going on for 100 years, this is not a new trend. We have fewer and fewer people occupying each housing unit than we used to. So it used to be like, there'd be 1,000 square foot house with 3 bedrooms, and you'd have 6 people living in it. And today you have a 1,400 square foot apartment, and you have 1.5 people living in it. 2 roommates or something like that. So the trend is you need more and more housing units for the population, but also we have fewer housing units per population. And that trend is not slowing down anytime soon, largely because all of the local laws everywhere are what prevents building. It's zoning laws and building codes that prevent profitable building of affordable housing units or smaller housing units, or just housing units in general. And so on average over the nation, that's not something that's slowing down anytime soon. And then on the demand side, we're seeing increased subsidized demand. We're seeing a push for 50-year mortgages. We're seeing purchasing mortgage-backed securities in order to bring more interest rates down. Those all contribute to increased demand. So I am bullish on real estate, especially single-family housing. It's a lot easier to build apartment buildings in many cities than it is to build single-family housing, and so that's my personal strategy. But I could be wrong. All right, what do you think about Litecoin? I don't like it. I only like Bitcoin. I don't like anything else. I bought TLT July 1,700 calls. That could be a profitable trade for you. You might have to time it correctly. Let's see what strike price you got. The 100. The 100. That's gonna need a big move. And then what date? July. I don't know, man. I hope they were cheap. If they're cheap, that could turn out to be an asymmetric trade. That's a big move. So if they're cheap enough, then that's like, that's an asymmetric bet, something that the market is not pricing in at all. Um, most likely it will not pan out. So this is where position sizing is so important, because if you position size correctly, it allows you to minimize risk or mitigate risk through position sizing alone. You don't have to worry about stops. You don't have to worry about hedges. If every single one of your positions, assuming they're uncorrelated enough, if every one of your positions is 0.5% of your portfolio, then the worst case scenario is you lose 0.5% of your portfolio if that trade fails. That allows you to make each individual trade extremely risky, in the sense that, like, it is likely to fail, but in the event that you are right, it will, because it's so leveraged, it's such a risky trade. It will make a significant impact on the rest of your portfolio. It'll 10x or 20x, and then that, if 0.5% of your portfolio 10x's, it becomes a overall increase on your portfolio of 5%. Like, that makes a big deal, makes a big difference. So that's why position sizing is so important, and it's a really easy way to manage your risk overall, and it allows you to take these trades that are unlikely to pan out, but if they do, they make you a ton of money, and then you don't have to worry about wrecking your portfolio and never coming back from it. All right, next question from Whiskey Papa 9846. I'm not a Keynesian, but if we stayed with the Austrian, oh, and by the way, what I just said there, that is something that is built into my trading strategy. Like, that is one of the reasons why I've been able to so significantly outperform the market over the last 5 years. All right. And if you want to learn more about that, link in the description below for next Thursday. The event is free. All right. I'm not a Keynesian, but if we stayed with the Austrian economic system through the 20th century, would we as a country have grown as much as we did? Okay, it depends on what you mean by we. So here's a good example of this. The interstate system is constantly pointed out as an example of a huge success of big government. If we didn't have a really strong, big federal government that did lots of infrastructure spending, we would have never got the interstate system. And the problem with that is number one, the interstate system absolutely devastated and annihilated and completely destroyed thousands of small towns because you no longer needed to, when you were doing interstate travel on the little roads that were already there and end up staying and spending money in all these thriving local towns and cities. Interstates allowed you to just completely bypass that, and it centralized and consolidated a lot of that wealth into major hubs at the expense of what had been there largely more organically. Um, and so it allowed the growth of certain entities off of off of intervention that would not have grown otherwise. And so this is one of those areas where it's actually very difficult, if not impossible, to say, hey, which one resulted in more wealth, because you can't go measure something that never happened as a result of the intervention. History is one of those things that it's untestable because you cannot repeat it. You cannot do like controlled experiments for the most part. The closest you can get is you can say, okay, we're going to draw a line. There's a people group here. They're all the same people, same culture, same everything. We're going to draw a line between them. And then this half is going to be under one system of government and this half is going to be under another system of government, and let the experiment run and see who does best. And what we have there is we have got like West and East Germany. We know how that turned out. We've got North and South Korea. We know how that turned out. It's like we have a couple examples of that through history where you have have split tests going on. But for the most part, you don't have that. And so the interstate system is a very good example of this, of your question overall, which is, hey, if we would have had sound money, it's like, well, the government itself would never have gotten so big and bloated and powerful. We would have never gone and done all these endless wars overseas. We would not be imposing, setting up new governments, tearing down regimes, putting up dictators, funding, creating the Taliban and Al Qaeda and ISIS, either directly or indirectly through all of our intervention. Like we would have never gotten to the point where we are today, that a lot of people look at that as a sign of bigness and growth and strength. And all of that has come at the expense of like the taxpayer and people, the wage earners and savers being, their wealth being confiscated through inflation. And so if you would have had sound money that entire time, all of that wealth would have stayed where it was originally, like in the people's hands, and been able to be more better allocated. People would have been able to make better decisions with it. And individuals largely across the board would have been able to be much, much, much wealthier. You would have had a lot less, though, like interstate commerce. So you wouldn't have as many like large giants that are recipients of that large state system. So like a lot of companies that are basically like large government contractors that get massive because they're just receiving so much taxpayer money from the U.S. government. For the most part, those wouldn't exist, and all that wealth would instead have been compounded and used more efficiently where it originated. So it's really hard to like it depends on how you measure it and what you mean by when you say, would we be wealthier? Many people would be, because many people wouldn't have had their wealth confiscated. But there would be other, like probably a lot of the billionaires and a lot of the large corporations that we have today either wouldn't exist or at least wouldn't be as big as they are right now. Which is funny because it's like the most libertarian approach to economics would result in like less wealth inequality and probably fewer billionaires and like less corruption and cronyism. It's like a lot of people look at those policies and say, oh, that's super right wing, when the results of that would actually be something that people on the left really, really, really desire. They just want to do it through force. They don't want to do it through freedom. All right. Let's see. Next question. How much do you earn in a month on YouTube? My views on YouTube are about over the last like 3 years, they've averaged out to about 1 million views per month. And that has averaged out for me around $5,000 to $6,000 per month. Now, that is just from the ad rev, like the ads that actually play on the YouTube videos that are built in by YouTube. I used to do sponsorships, I used to do affiliate deals, all that. I'm not talking about any of that. I'm just talking about what the YouTube channel itself generates. It's like $5,000 or $6,000 a month. Just for reference, that doesn't even pay for my video editors and my graphic designer. Like that's like it's it's not. I mean, if I was doing it all myself, and like in the beginning when I was doing it all myself, like that was enough. Like I could pay my bills with that. But it's nowhere. It's it's less than a 0.5% of my total income. It's like a rounding error. It's nothing now. Um, but it's the amount that I make from my YouTube videos is a little bit higher than the YouTube average because of the content. T Financial content, economics, investing, business, though, and real estate, those tend to be on the higher end of what you get paid from YouTube because they're just splitting the ad revenue with you. And typically, the viewers who are watching this kind of content have more money to spend on things that people can advertise for on those channels. And so the ad spend itself is higher. So if I was going to run ads on somebody's YouTube channel that was similar to mine, I was a company paying for that ad space, I would have to spend a larger amount of money in order to win that ad space, because the buyers who are watching my ad are more qualified. And so, um, if you're doing a different type of YouTube channel that is geared towards either less wealthy people or children or products that are generally cheaper, then your ad revenue per view is going to be a lot lower. Um, so hope that makes sense. It's good, but it's not anything crazy. All right. Next question here. So your argument against government spending on highways is that it wrecks mom and pop. Kind of. You're laughing at that, but kind of because that is a government decision to do something that people would not be choosing to do otherwise. That's what we have to recognize about any government action, whether it's a law or a spending decision. It is it changes human behavior from what humans would have chosen to do otherwise. When you look at like when a city decides to build a like a stadium for a sports team, that is something that normally the sports team has looked at that and looked at the number of dollars it would take to do that and decided, hey, this is not profitable enough for us to spend our money on this. So they convinced the government to make the taxpayer pay for it. And so that's a capital allocation that is not profitable enough to be chosen in the free market. And so instead, somebody chooses to do it by force, which is going to result in less wealth overall than there would be otherwise. Um, that's the exact same thing with government choosing to spend, because if the free market, if that opportunity was profitable enough, the free market would have done that already. And also, the interstate system may have eventually come about through free market individuals choosing to buy up that land and do that anyway, if it was profitable enough. And then you would have also had the people who were using it paying for it. And and so it misallocates capital. It results in less total wealth overall, and it is somebody choosing by force different winners and losers than there would be otherwise. All right. Question from unknown YTX. You said before that layers on top of Bitcoin is normal, but those layers are centralized, which goes against the whole selling point of crypto, decentralization. No, I mean, I don't, that's one of the selling points. If you need a pseudonymous, permissionless uh, way to make a payment, You can do that with Bitcoin. If you need a way to send a payment that is cheaper and faster, you can do that with a layer on top of Bitcoin. So it allows choice. Um, because there's advantages and disadvantages to everything. There's always a cost, there's always a trade-off. And so it just allows you the choice to choose to transact on a higher layer. Like for instance, if you want to be able to guarantee to be able to like pull the funds back, like you can with a credit card. If you make a purchase with a credit card and it's a fraudulent purchase, the company never sends you the product, then you can do a chargeback and you can get that money back. If you send a wire to that company though, instead, you are never getting that money back. Um, and so there's always a trade-off. If you prioritize permissionless, record of settlement, um, you know, uh, base layer transactions, you can do that if you prioritize speed or being able to claw the funds back or anything like that. That's what layers on top of that are for. And all money systems are like this. The dollar system is like that as well. Okay, from KJ Quarter. For those lacking time and know-how to trade options, are covered call ETFs a worthwhile way to play that game? Thanks for these sessions. No. I always warn people, caution people to stay away from those things. So if you have a business that is profitable and has excess profits, they can take some of those profits and hand them out, divide them up between all of the owners of the business that's paying a dividend. So that is income from a business that is produced from real business activity. Um, now, if another form of investment that allows income is debt. If I loan you money and you don't have to pay me back for a certain number of years, you will pay me an income on that debt along the way. So that is the interest rate, and so or the yield on the debt. And so both debt and profitable businesses can pay real income um, to investors. So many people look at ETFs and they will look at the dividends. They're called dividends that these ETFs are paying, and they'll say like, "This is fantastic. It's an ETF, it's a fund, it's invested in real business, and I'm getting a great dividend from it." What they don't realize is those dividends are not being produced as a result of real business activity or interest on debt. Those dividends are being produced as a result of um, financial contracts by giving up upside in those securities to somebody else in exchange for current income. And what you'll find every single time, if you track the total performance of those covered call ETFs or the cash secured equity put ETFs, the structured income ETFs, you track the total performance, that includes the dividends, it will always underperform the underlying. Whether or not the underlying is in a bull market or the underlying is in bear market. When you look at like the MSTY, the covered call ETF on MicroStrategy, they've both been in a bear market. Misty has underperformed MicroStrategy. When you look at something like SPYD, well, no, that's the dividend one. There's plenty of them covered call ETFs on like SPY. They underperform, and the reason why is because they're giving up upside in exchange for that current income. So when the underlying does perform well, you lose out. Now, why is that different than doing covered calls yourself? It's because ETFs are regulated and governed in a very specific way where they have to continually roll over the exact same strategy in a very predictable manner that has already been pre-approved. And so if the stock goes down and I'm managing this ETF, I can't just decide, well, I'm not going to sell a covered call this month because the income from that is not worth it relative to where the stock is. Plus, I don't want to risk getting called away. The ETF still has to perform the exact same strategy. So what you have over time is very often missing out on the big runs up and then having to rebuy because they got called away and they have to rebuy at higher prices. And then it comes down and then they take a very small amount of income and then it goes back up and they sell it at a loss. So all of those little underperformances along the way contribute to massive underperformance over the long term. As an individual, though, you can avoid this trap yourself by only selling covered calls strategically. Like when you're already at a gain and the market has had a big run up, and the VIX is at a at a reasonable place, and the greed index is high. Like you can approach it strategically and say, I'm going to skip selling a covered call this month because it's just not worth it. Whereas ETFs can't do that, and so you can over the long term do a lot better by either just holding the underlying or even selling covered calls yourself versus these funds that do it for you. They're none of them outperform the underlying. Okay. From Michael Good. Do you see any scenarios for the U.S. federal government to buy out all the land and tracts from railroad corporations to lease back to the public, kind-ish like interstate system? I don't know. Is that something that I don't know? Is that something people are talking about? It seems kind of like a random. I mean, at this pace, I wouldn't be surprised no matter what the government does. Like they could do anything, and I wouldn't really be shocked. Um, I don't know. I mean, yeah, I guess it's possible. Is that I don't know if that's something that is being discussed as being considered right now. All right, from Jules, can you please explain how this works? The market grows at 7 to 10% per year, but GDP grows at 2 to 3% per year. How does the market grow at such a higher rate? Well, GDP is the total value of the stuff that gets bought and sold during a year. The market grows based on what people are willing to pay for the market. Um, and so it might come down to just a misunderstanding about like where the money is going. A lot of people think, oh, all the dollars are getting sucked into real estate, or all the money is going into Bitcoin, or everything is flooding into gold right now, or stocks are absorbing all the investment capital. It's not how money works. When you purchase a stock, dollars leave your brokerage account and then they get deposited in the brokerage account of the person you bought the shares from. The number of dollars in the system doesn't change from that. It just changes who's holding those dollars. There is no non-debt transaction that has any effect on the money supply. The money supply stays the same. It's just that people are willing to pay a higher price for those assets, and sellers are unwilling to sell at lower prices for those assets. Part of the reason for that is that people are willing to pay higher and higher prices is because of the increase in the money supply. The dilution justifies higher valuations, and the increase in the money supply eventually works its way into increasing earnings. Um, but the dollars in the system stay the same. The only transactions that have an effect on the number of dollars that exist are debt transactions. When um, when debt is created, that is new money. Money is loaned into existence, and when debt is paid off, that money ceases to exist. So that is how money is created and destroyed. It is through debt, through borrowing and debt payoff. But the market going up is just because people are willing to pay more for it, and the number of dollars in the system doesn't change from that. Are you reformed in your theology? No. All right, Supendul. Do you think I, as a European, should focus more on EU stocks, or does the US market still have more upside in the future? That's a good question. Part of it comes down to the ability, like what you have access to. So, um, depending on where you are, it may be fairly expensive for you to be able to get exposure to US markets. It also may be fairly like restricted and limited. Like if you can open up a brokerage account in the United States and have full access to US markets, stocks, ETFs, maybe even options, it's like, yeah, the US markets are the deepest, most liquid, most financially sophisticated, all the instruments and like the liquidity and everything. It's like you're going to want at least for the foreseeable future, that's not changing anytime soon. The place on earth that is the most financially it's the financial center of the world, um, tends to be the, uh tends to be concentrated at like the global superpower. So it used to be in London, and now it's New York. Now it's the U.S. That aspect, even when empires start to fall, that aspect stays around. It's one of the longest things to the most stickiest thing. Um, it's the global reserve currency and the financial center of the world. Like that is the stickiest thing, even as empires start to fall. Is one of the last things to change. Um, and so for the foreseeable future, even if the United States descends and begins to fall and collapse, that won't change for a long time. So I would say if you have easy, cheap access, then yes. If not, something like even just a broad global fund will give you decent exposure. That includes access to just not access, but like includes exposure to the U.S. stock market overall. Um, but the more access you have to market, the more opportunities you'll have to do, more maybe more active trading, choosing individual stocks, hedging, that kind of thing. So that stuff might be more EU focused for you. Um, have you? This is from Shuli Konikita. Have you thought of creating a hedge fund? Yes, in fact, I went down that road and decided to stop. And the reason why is because if I start a hedge fund based on the way that I'd be investing, there are certain like thresholds where you're like exempt from specific restrictions on who can invest. And so I was like, all right, perfect. Like I want to be able to start a fund where at least hedge fund it's accredited investors only. There's one carve out where you can allow non-accredited investors, but it is extremely difficult. The reporting requirements and the cost are insane. um, the the lawsuits, like people who start these funds that allow non-accredited investors, they're the lawsuits are just constant, because non-accredited investors tend to, well, if you have 10 grand to your name and you invest 5 grand into something, that's half of your net worth. So you're going to expect the world from that. And nobody's ever going to be able to meet those expectations. And so these funds that do allow, they're constantly getting sued. Um, and so that was not something that interested me, but it's fairly common and easy enough today for people to become accredited investors, because that you can qualify from income or from net worth or from taking tests. And so if you qualify as an accredited investor, I was like, okay, perfect. But the problem was, once you get over 99 investors, once you get over 99 investors, then you need qualified purchasers only, which is a $5 million net worth. And so then I was like, okay, well, either then I have to keep on kicking out my smaller investor every time a larger investor comes around in order to grow the fund, or I need to just say first come first serve, the initial 99. But then I'm not able to perform a service for all the people that I want to help. And I'm just not interested in setting up a business where it is geared entirely towards already high net worth or institutions. It's just not something that interests me. I am far more interested in helping people get from zero to investable, and then get from there to achieving financial freedom. Not really concerned about helping somebody dial in their portfolio allocation who's already a high net worth individual. So the entire financial industry is regulated and uh, uh, arranged in such a way that benefits people the more money they have, and is more and more difficult for people the less money they have. And it's unfortunate. Those are laws. And so because of that, I decided not to start a hedge fund, because I wouldn't have been able to help out the people I want to help out anyway. Okay. From Mini Stick Snipes. I don't share political views, but CBDC sounds like way too much control from the government. What do you think, or is it inevitable? Well, I would like to propose a thought experiment. Let's say a CBDC existed today already. How would you know? Like, what if behind the scenes, the dollar already was a CBDC. So it's digital already. So we got that part down. What does CBDC stand for? It's central bank digital currency. Um, what is the foundation of the dollar system? It's at the Federal Reserve. The Federal Reserve is our central bank. So the central bank issues a digital currency that everybody uses today. So what is the difference between the system we have today and what people call a CBDC? The difference is the consolidation of ledgers. So right now, the dollar exists as a distributed ledger money system where each individual bank has their own ledger. And then the central bank has its own ledger, which is it's a bank for banks. And so the banks have their bank accounts at the central bank. And then each bank has its own ledger where we have our bank accounts at those banks. And so it's a tiered system of distributed ledgers. That is the digital dollar system that we already have today. A ledger is simply like an Excel spreadsheet. Like it's a list of account numbers and the personal info associated with each of those account numbers, and then the transactions that have happened with each of those account numbers. That's all a ledger is. And so that's what the banks maintain for us today. When money transfers from one bank to another, they do batch settlement between each other. So they're not every time I send money, every time the grocery store and I send money to, I send money to the grocery store and then a grocery store sends money to its employees. That's not all of those transactions are not happening between banks. Banks do batch settlement with each other. And so of all of the, billions of dollars that go from Chase to Bank of America, and then the billions of dollars that go back to accounts the other way, they're just going to take the difference and do one batch settlement between each other. And that happens at the Federal Reserve level. So the only difference then between this system then and a central bank digital currency is that we have one ledger where everybody then has an account at the Federal Reserve. The problem with that is we need infrastructure in place in order to handle all of that data. And that's what the banks would be for. And so instead of having actual distributed ledgers, we have the banks operating as the plumbing system for the central bank digital currency. And assuming that no changes happened with the management of that system, nobody would ever know if we switched over to that right now. In fact, they've been running, I don't know if they stopped running the experiment, but they ran a CBDC experiment system alongside our own dollar system in the background just to test it out to see if it would work. And so assuming they didn't manage it differently, we would know no difference. The issue is that they then had the potential to run it differently. This is why like 10 tyrants are better than one. 10 tyrants competing for power are better than one. Right now, if you run a business with firearms or marijuana or gold or some of these or Bitcoin, crypto, like there's some industries where if you have a business in that industry, it can be very hard for you to maintain a business bank account somewhere. Chase will shut you down. Bank of America will shut you down. Wells Fargo will shut you down. And so then you have to go and find somebody else who will run a bank account for you. But at least there's other options. Under a CBDC, it's all consolidated on one. And so if they decide, hey, this kind of business is no longer allowed, there's nowhere else you can go. You are unbanked immediately, permanently from the entire system. And so the potential for abuse of power is almost infinitely higher in a system like that. That doesn't mean necessarily that they would actually use that power, but they probably would. And then they have the ability to, do direct taxation and implement rations on things. Basically, it gets to the point where since money is half of every transaction, you can command and control the entire economy if you can control every transaction. Versus right now, monetary fiscal policy and legislation, they have to implement things through other routes of enforcement. But if you can control every single transaction that takes place, then all that can be handled at the money level. All right, next question. Do you think that personal income tax should be zero like it is in some countries, the UAE, for example? Yes. So it depends on how far you want to go with this. If you are going to have an involuntary tax, then the question is, okay, well, what's the most fair involuntary tax? And the answer to that would be a sales tax, because that's the most voluntary type of tax you can have in an involuntary tax system. Um, it also aligns incentives best for long-term growth and personal financial good habits. If sales tax is the only thing that exists, then it punishes consumption, but you can save and you can invest without ever having to worry about paying taxes on that. And so it incentivizes delayed gratification, incentivizes savings, incentivizes investing. And then once you go out and start consuming, then you're going to get taxed on that. The top 10% consumes is responsible for like over 50% of consumption. And so it'd still be a progressive tax in the sense that the upper end of income and wealth would still be paying the vast majority of the taxes. But it would not be a transfer system where you have, well, no, we're not talking about the spending side of it. So you'd still have entitlements and spending by the US government that would probably result in the lower end still coming out on top, or net zero taxes. But it incentivizes the right behaviors, disincentivizes the right behaviors, and is the most fair because you can delay or decrease your taxes simply by changing your behavior, and reducing consumption. Whereas an income tax is like literally the opposite. All right. Where would you invest $5,000 right now for a 1-year return? I mean, if all you have is $5,000, you probably shouldn't be worrying about investing, to be honest. If all you have is $10,000, if all you have to your name is $20,000, you shouldn't really be worried about investing at all. It's not going to make a huge difference for you in the long term, whether you park $20,000 in the S&P 500 or the NASDAQ or in VWO or in an automated betterment account or Schwab Intelligent Portfolio or something like that. It's really not going to make that much of a difference. What really grows your wealth long term is the total amount of money that you can invest. So like if you're investing $1 million, that makes a big difference dollar-wise where you put it. Because if you're investing 10 grand right now, because that's all you have to your name, if you get an insane return, like you get a 50% return, which is like some people can do it in 1 year. It's not something that people do over and over and over consistently. The best hedge fund of all time had a lifetime annual return, compounded annual growth rate of 67%. And that was before fees. So even if you get a 50% return, that's only $5,000. And that's not going to happen every single year. Whereas if you're investing $100,000 and you only get a 10% return, which is going to be like pretty much every year in the stock market, that's $10,000 for you. So the biggest thing you need to focus on is your ability to invest more money. And the only way you can do that is to grow your income. And so if you're making 50 grand a year and you have 10 grand to your name, do not worry about investing. Focus all of your efforts on increasing your income. Financially speaking, all of your effort should be focused on growing your income drastically. That is where you're going to get the highest return on investment of your effort and of your time, is by focusing on increasing your income. Because once you can start investing 50 grand a year, you're going to build wealth very, very, very fast. But if you can only invest 2 grand a year, 5 grand a year, you're going to build wealth very, very, very slowly. And maybe you'll have enough to retire when you're 65, 70, 75. If you focus all of your effort on increasing your income, you will shrink the time frame down between now and financial independence enormously. So much more than focusing on increasing your return from an average 12% to 13% to 14%. All right. From Christian, if the DXY would move up, would TLT be a safe bet or long the dollar via Forex? I think the dollar index is going to move higher, simply because right now we are exporting fewer dollars overseas than we have in like a decade. The trade deficit is the lowest it's been. And that means with all the trillions and trillions, the $100 trillion or so of dollar denominated debt out there, there's a dollar crunch that is building. It means dollars are less abundant, they're more scarce than other currencies. And that will continue because debt, just in its existence, is deflationary because you must pay back more dollars than what you borrowed. So if you just have a pile of debt and leave that alone, that will have the effect of decreasing the money supply because as that debt gets paid off plus interest, those dollars cease to exist. And so, um, if the trade deficit continues to shrink or even just stays where it's at now, it will have the effect of lifting up the value of the dollar versus other currencies. I think TLT, short term, bond prices are probably going to go up. And absent yield curve control, they will go back down. They may continue to go back up through yield curve control, though. That is something that this administration and the Federal Reserve has begun to speculate on doing soon because of all the debt that the U.S. government needs to roll over. What is the likelihood of another CME margin? I'm assuming you mean increase in margin requirements. I think it's fairly likely, but not like when you look at what happened in like 2011, I think margin requirements are already way higher than they were back then. Don't quote me on this. I'm pretty sure. So they're already pretty high. Sure they could go higher, but I'm pretty sure they're already pretty high. So I personally wouldn't be too worried about something like that. All right, from David. Any opinion on AI, AGI for 2026? RAM memory prices at all-time highs relative to early 2025. Micron earnings per share have reflected this demand. Yeah, right now I'm long Micron, long Intel, long SanDisk, long ASML. I'm trying to think of any others. Overall, though, I'm bullish. And again, I share my positions with you guys just so that you know how strong my opinion is. Because if I say, oh, yeah, I'm bullish on that, but I don't have a position, then it's like, well, I'm clearly not bullish enough to have a position that is bullish. And so I just share my positions with you guys just so that you know the bias and the strength, the conviction of my opinion when I state it. I have skin in the game with my opinions. And when I don't, as much as I remember, I share that with you. Okay. From Peter. Will lack of energy pop the AI bubble? And if so, when do you think that'll happen? No, I think there's enough there's enough agility in the ability of decentralized energy producers to be able to meet short-term demand. It seems as if we are moving into an era where there is going to be more and more and more decentralization of the production of energy and less and less reliance on the grid. And I think that is a good thing. But we have companies like Bloom Energy, for example, which I'm long, that they go and set up a bunch of natural gas generators on site. And so that data centers and hospitals and whoever else, they can just produce their own energy. Our grid is like 50 years overdue from needing a complete rehaul, a complete rebuild. And decentralized energy, especially solar panels, batteries, small modular nuclear reactors, natural gas generators, diesel generators. These are all things that I think we're going to see that trend continue. It is profitable enough to incentivize companies to be able to stand that up quick, that the increase in demand for energy will be able to be met by decentralized energy production and will not be constrained by just the grid not being able to supply it. So no, I do not think energy will pop the AI bubble. I think, excuse me, I think the AI bull market will continue to increase the production of new energy through all of that extra demand. And a lot of that will be done privately, like Meta just signed signed a deal with Oklo. Amazon has purchased nuclear sites. I think, was it Google or Microsoft that purchased 3 Mile Island or a portion of it? So a lot of that will be done, privately. It's not going to be done by like enhancing the grid. Okay. I don't think they were asking if they only had $5,000 to invest. I think they were asking if someone had 5,000 to invest right now. Well, that's the problem, is because I don't like, it depends on what, that's kind of an unanswerable question, because I don't know what else you have. It's like, do you have $1 million invested in your 401k across a couple of mutual funds? You've got your home that's paid off, and you've got, some gold in your safe. And now you have an extra $5,000 that you just got from like a tax refund, and you're wondering where you should put it. It's like, well, it doesn't matter. No matter where you put it, it's not going to make a dent in your overall portfolio. So just, I don't know, pick the spot where you're undervalued right now, underallocated. On the other hand, the other end of the extreme, if that's all you have to your name, you shouldn't be investing. And so it really depends on what you have. Like, it's not an answerable question with those levels of details. So, that's, I mean, as much as possible, I try and answer these questions with the information that's given. And if the question is, hey, I have $5,000, where should I invest? Given that information, all I know is that you only have $5,000. And so that's why I answered it that way. But that's a very different question than saying, hey, I've got $100,000 portfolio and I just got an extra $5,000. Well, now that means your cash allocation is $5,000 higher. Should I be rebalancing? So it's a different question. So try and answer questions with the information that is given. All right. Do you like the REIT market going forward? I'm not a huge fan of REITs, specifically because they're missing out on most of the advantages that you get from investing in real estate. So I like investing in real estate because of the debt advantages. Like, you can't get a 30-year mortgage on stocks. You can't take out a 30-year fixed rate mortgage to buy a real estate investment trust. But you can get a 30-year fixed rate mortgage to buy a single family rental property. You also can't cost segregate and bonus depreciate a stock or an ETF or a real estate fund. But you can do that with an apartment building or a duplex or a single family rental property. Also, Warren Buffett is not going around picking up $150,000 rental properties. But big money is buying REITs. And so there's an arbitrage opportunity that exists for small investors, where there are profit opportunities that exist only for small investors because they don't move the needle for large investors. So, like, another example of this, Warren Buffett's not going around finding stuff for free on Facebook Marketplace and then flipping it on eBay. Even though you can make 200, 300, 400, 500, 600, 700, 1,000%, it's still only $40 a pop or $50 a pop or maybe $100 a pop. So even though the percent gain is amazing, that's something that exists only for the very small investor, for the small hustler, for the side gig, for the person who's trying to make some extra cash. That is never going to be arbitraged away by big money coming in and scooping up that entire market, because the dollar amount doesn't move the needle. And so this exists all across markets. Even in public markets, you have a lot of times, like, you'll have a spinoff of, one company will spin off a division that's a much smaller company, and all the big funds will now dump all those shares because it's not a large cap anymore and they can only hold large caps in the fund. So it's like they're selling and the price is falling, not because it's a bad investment, but because it doesn't move the needle for them. Just them rebalancing would move the stock. So they got to dump the shares. And so there are opportunities that exist specifically and only for small investors, even though the percentage profit potential is very good. um, the dollar amount doesn't move the needle for large investors, and so big money's not touching it. So for those reasons, I like physical real estate. I don't like things like REITs. Okay. What do you think about the next type after AI to be around robotics? I mean, that's happening right now. I don't think it's next. I think it's one and the same because depending on the type of robotics that you're talking about, you need basically AGI in order to be able to run these things. Like that's why self-driving is such a hard nut to crack because it basically requires AGI. There are so many different data inputs happening at the same time that constantly have to be filtered out to focus on the one piece of data that actually matters. And then in a nanosecond being able to switch to start using the data that was just being filtered out because suddenly it becomes significant. It's like it's it's an AGI problem. It's not really a hardware problem. Um, and that really exists for most of unless you're just talking about very straight tasks that are programmable of like if this then do this just straight up like move there then move back then move there then move like those kind of things. Those are basically a hardware problem and that's been solved for a long time. But the reason why we're now seeing such a fast rate of increase in advancement in robotics, like, I don't know if you guys have seen the chart, but Amazon over the last like couple of years, their head count of personnel has been drifting down and their use of robots has been steadily drifting higher. And within a couple of years, they will have more robots than they do people. And so it's happening. It's happening like as we speak. I don't think it's the next thing. I think they're basically one and the same. How do you feel about paying off your home versus investing the capital? It depends on what your mortgage rate is. If you have a mortgage rate under 3%, it is there are very few financial decisions that are dumber than paying that off. That is a purely emotional decision. It has no math whatsoever to back it up. Um, you could park that money in a high yield savings account, in a T-bill ladder, in a CD, in a 30-year government bond, and you could use that to pay your mortgage, and you could consider yourself mortgage free because you have a fund that's paying that mortgage payment for you. It just mathematically does not make sense. But if you got a mortgage at 6% or 6.5%, it's like, okay, well then the difference between what you're paying on that debt versus what you're going to make in the market, many years will be negative because markets can go down. And you're not going to find a money market fund that's going to pay you 7%. So if you've got a really high mortgage rate, then yeah, it definitely makes sense to pay that thing off. So it all depends on the interest rate that you're paying. If you're in the realm of like 4%, 4.5%, then it becomes a little bit more sticky. And then it's like, yeah, sure, involve a little bit more emotion. Look at the math. It's not going to be as cut and dry. But at the ends of the extreme, it's like you've got a 2.75% mortgage rate. That'd be the dumbest financial move ever to pay that off. You've got a 6.5% mortgage. It's like, don't keep that any longer than you can, or than you have to. Pay that thing off quick. All right. From Arthur, and this is going to be the last question here because I'm starting to lose my voice and I still need to record a video for today. All right. Have you ever examined the MicroStrategy preferred stocks? Even for a MicroStrategy bear, STRF looks like an over collateralized perpetuity with the main risks being Bitcoin going to zero and custodian risk. I did an entire video about this called "Is MicroStrategy a Ponzi Scheme?" But yes, these funds rely on MicroStrategy's ability to raise new money. MicroStrategy does not produce any cash flow. So earlier in the live stream, I was talking about dividend ETFs that produce that income from selling covered calls. These are preferred shares that can only pay if the underlying company can continue to dilute or borrow. There is no underlying business activity that is producing that income. And so if they cannot raise more money from debt and if they cannot issue more shares because the shares are below MNAV, then they'll have to sell Bitcoin. Now they have a year till they get to that point because they have some cash from their last share issuance. But that's still the case. Like that cash came from selling shares. And so if they cannot continue to do that, then they must start selling Bitcoin in order to pay that. And in fact, MicroStrategy CEO said directly that they would do that if they had to. And obviously that's the only way they could. And they are very loud spoken about, oh, we've got 70 years of Bitcoin in order to do this. But it's like, if it gets to the point where they have to sell Bitcoin in order to pay that, the price of Bitcoin and the price of MicroStrategy are going a lot lower. So they won't have 70 years at that point. They might have a lot less. And so personally, I don't think that sort of also they on many of I don't know if it's all of the preferreds, but on most of the preferreds, the dividend is they have the ability to shut the dividend payments off if they need to. And so in my opinion, it's not worth the risk. Now maybe if the you're just nailing the bottom in Bitcoin and Bitcoin's going to just go up from here, then it would turn out to be a good bet. But that doesn't change the fact that given the information you have about it right now, it is a very high risk strategy. All right. That was the last question. I want to reiterate, guys, though, next Thursday, I've got my free Portfolio Accelerator Masterclass. For those of you who just joined and didn't hear me talk about it earlier, over the last 5 years, I've been able to have a 37% average annual return in my portfolio. That's over double the S&P 500 and other indexes. That compounds so that over the last 5 years, my cumulative return is over 370%. Which all the major indexes over that same time period are under 100%. So a little bit of outperformance on a year-to-year basis allows drastic overperformance over the long term. And the only way I've been able to do that is because I take a portion of my portfolio and I apply a very specific trading strategy to it, where we manage risk extremely carefully. We take asymmetric trades. We do use options. Take a very specific strategy, and the excess returns in that part of the portfolio contribute to overall outperformance. And so if you would like to learn my strategy, I'm holding a free Portfolio Accelerator Masterclass next Thursday. The link is in the description below. Click on that, sign up for that if you are interested. Really appreciate it. Great questions today, guys. And we'll see you. I'll plan on trying to do another one of these on Monday. So I'll see you then.